Imagine a country just brimming with natural resources, a really big young population, and this strategic location that just seems to scream untapped potential.
Sounds like an investor's dream. Right.
Exactly. But what if there are these powerful, often kind of hidden political forces constantly pulling at its economic future, influencing billions in foreign investment?
Mm-hmm.
Well, that's exactly what we're diving into today. We're looking at foreign investment in Iran.
A really complex picture.
Yeah, and we're going to unpack this fascinating study that looked really closely at what drove, or maybe more often, what held back foreign investment there between 1993 and 2017.
Right.
And this isn't just about numbers, is it? It's about politics, it's history, how the world interacts.
Mm-hmm.
It shapes these real-world markets.
Absolutely. And the core question this research tries to tackle is, does political instability, specifically things like external restrictions like sanctions, does that really impact foreign investment, both short-term and long-term?
That's the crux of it.
Yeah.
And it's a huge question when you look at Iran's profile. I mean, back in 2017, it was the second largest economy in the Middle East.
Huge.
And the population, average age just over 31, total over 81 million people. That's a dynamic workforce.
A young market. Yeah.
And then the resources.
Yeah.
I mean, world's second largest natural gas reserves, fourth largest oil reserves. On paper, it just screams high potential.
It really does. Okay, so let's unpack that a bit.
Right. So with all that potential, it's maybe not surprising they did see quite a few foreign investment projects announced.
There was definitely interest.
Yeah, 2017, 98 projects worth about 4 billion euro. Then in 2018, it jumped 114 projects, almost 8 billion euro.
So significant numbers.
Real money, and the sector's pulling it in. Industry and mining was biggest, 3.74 billion euro. Energy next, 2.66 billion. And services got a decent chunk too, around 2 billion euro.
So the interest was definitely there across key sectors.
Clear.
And Iran, they actually made some serious moves to try and attract that capital. A really big step was this new law, the Foreign Investment Promotion and Protection Act, or FIPA.
FIPA, right.
Yeah, it came into effect around September 2002. You can think of it as Iran basically rolling out the welcome mat for international money.
Trying to make it easier.
Exactly. It aimed to streamline things, cut through the bureaucracy. They centralized the process through one body, the OIETI.
OIETI.
Organization for Investment, Economic, and Technical Assistance of Iran. Basically like a single point of contact for foreign investors.
Okay, that makes sense. Cut down the red tape.
Yeah, and crucially, FIPA also offered better legal security.
Yeah.
Approved projects got the same rights as domestic ones, and protection against nationalization or expropriation.
That's huge for investors, right? That security aspect.
Massive reassurance. And it also broadened the ways people could invest, direct investment, portfolio investment, even things like buyback deals or build operation transfer projects, especially for the public sector.
Okay, so you've got this undeniable potential, these vast resources, the young market, and then you add this seemingly welcoming modern legal framework like FIPA, specifically designed to pull in foreign cash.
Right. It looks good on paper.
But
yeah,
despite all that, why did the actual growth rates for foreign investment sometimes, fall short of what you might expect? This is where it gets really interesting, I think.
Yeah, this is where that idea of political instability really hits home. Economically speaking, you can think about it using transaction cost theory.
Okay.
So when there's a lot of uncertainty and political instability creates huge uncertainty, it's incredibly hard for investors to predict what's going to happen next, right? Or how stable their returns will be.
Makes sense. Risk aversion.
Exactly. So to minimize the risk, the potential losses, the exit costs, investors tend to pull back. They reduce their exposure.
They get cautious.
Very cautious. And in Iran's case, this instability has been massively shaped by this long, complicated history of external restrictions, mostly sanctions. And the study, quite cleverly, broke these down into different periods based on how intense the restrictions were, like a scale from 0 to 3.
Okay, so 0 is minimal, 3 is maximum pressure.
Basically, yeah. And it's worth remembering, sanctions aren't new for Iran. They go way back, even to the 1950s oil nationalization. But for this study's focus, period 0, which was 1993 to 1995, that was a time with no significant external restrictions, a relatively open period.
Okay, the baseline.
Then came period 1, from 1996 to 2005. This is when the U.S. started imposing unilateral restrictions.
Unilateral meaning just the U.S. at this point.
Primarily, yes. In May 95, there was U.S. Executive Order 12959 That was a pretty comprehensive trade embargo. It basically stopped U.S. citizens, companies, banks from doing most business with Iran.
Wow, okay.
But the key thing then was, yeah, it was unilateral. The EU, Japan, Korea, they didn't join in at that stage.
Interesting. So the U.S. was going it alone initially.
Largely, yeah. And then in December 96, the U.S. brought in the Iran Sanctions Act, ISA. That specifically went after Iran's energy sector, targeting investments over $20 million a year.
Hitting them where it hurts the energy sector.
That was the aim. So initially it was mostly U.S. pressure.
But then it escalated. You mentioned other periods.
It did. Period 2. That's 2006 to 2008. This is when the restrictions started to go international. The big driver was growing concern about Iran's nuclear program.
The nuclear issue. That changed things globally.
Big time. July 2006, the UN Security Council passed Resolution 1696. It urged countries to stop transferring materials and tech related to nuclear and ballistic missile programs to Iran.
So now it's the UN involved. A much broader pressure.
Exactly. Carried global weight. And these calls were repeated, even strengthened, later on. Then the EU got more formally involved in April 2007 with Regulation 423/2007.
What did that do?
It restricted dual-use goods going to Iran. You know, things with both civilian and potential military uses. That made business much more complicated for European companies.
Right. More hurdles, more paperwork, more risk.
Definitely. Now, period 3, running from 2009 to 2014, this was really the peak intensity. The squeeze got incredibly tight, particularly hitting Iran's banks and that crucial energy sector.
Okay, peak pressure. How did that manifest?
Well, March 2008, another UN resolution, 1803, urged extreme vigilance on financial transactions to stop nuclear financing. That led to serious practical restrictions on Iranian banks operating internationally.
Making it hard to move money.
Very hard. The EU also tightened rules on payment transactions and Iranian banks abroad. Transaction costs shot up.
So companies had to find workarounds.
Some tried, yeah, using banks in places like Iraq or Armenia, Georgia, or even doing sort of basic goods for oil swaps with China just to bypass the formal banking system.
Wow, that sounds complicated and risky.
It was. Then, October 2008, the U.S. Treasury's OFAC Office of Foreign Assets Control brought in the Iranian transactions regulations. That basically stopped any U.S.-linked financial institution from dealing with Iranian banks.
Cutting off access to the U.S. financial system.
A huge blow.
Huh.
And the ripple effect was massive. Then July 2010, the U.S. passed the Comprehensive Iran Sanctions, Accountability, and Divestment Act, CSADA.
Sounds serious.
It was. It expanded earlier restrictions and put incredibly strict conditions on any foreign bank wanting access to the U.S. financial system if they also dealt with Iran.
So pressure on non-U.S. banks, too.
Absolutely. Non-U.S. banks faced millions in fines. Between 2006 and 2016, something like 80 non-U.S. banks were forced to cut ties with Iran completely.
80 banks. That's significant isolation.
Huge isolation. And adding to that, February 2010, FATF, the Financial Action Task Force.
They deal with money laundering?
Right, and terrorism financing. They imposed requirements for enhanced due diligence on any transaction with Iran, another major obstacle for banks.
Just layer upon layer of difficulty.
Exactly. Then, maybe the biggest single blow to banking came in March 2012.
What happened, Ben?
Iranian banks were disconnected from the SWIFT network.
SWIFT, that's the global messaging system for bank transfers, isn't it?
The backbone of international finance, yeah. Being cut off from SWIFT basically disconnects you from the global financial system.
Wow, okay. That's near total financial isolation.
Pretty much. And it didn't stop there. August 2012, the U.S. banned its own foreign subsidiaries from dealing with Iranian entities.
Closing loopholes.
And finally, January 2013 brought U.S. secondary sanctions.
Secondary sanctions, what are those?
These were really powerful because they targeted third parties, companies not based in the U.S. The aim was to force them to comply with U.S. sanctions by threatening their access to the U.S. market if they dealt with Iran in key sectors.
Which sectors?
7 key ones. Banking, insurance, energy and petrochemicals, shipping, gold and precious metals, software, metals, and the auto industry, basically hitting the core of the economy.
A really comprehensive economic squeeze. Unbelievable pressure. So what happened when some of that finally eased up a bit?
Well, that brings us back to period 2 intensity, but this time it's 2015 to 2017. This was the period of the JCPOA.
The Iran nuclear deal.
Exactly. The Joint Comprehensive Plan of Action. Signed July 2015, confirmed by the UN Security Council. This led to most international sanctions being lifted by January 2016. They called it Implementation Day.
So a moment of opening.
A significant opening, yeah. The EU repealed a lot of its measures. Those U.S. secondary sanctions were scaled back. FATF eased its demands. And crucially, SWIFT was reconnected in February 2016.
So the financial channels reopened.
They did. It created this brief window of, optimism and opportunity.
Well, you said brief.
Yeah, because it's crucial context, even though it's after this study's period ends, that in May 2018, a new U.S. administration pulled out of the JCPOA and reimposed most U.S. sanctions.
Right. So the opening didn't last indefinitely, but the study captures that period of relative openness.
It does. It captures that fluctuation.
Okay, so we've got this incredible history, this back and forth of sanctions and openings.
Yeah.
How did the study actually measure the impact of all this political pressure on foreign investment? What did the data really show?
Right. So the methodology. They used a statistical technique called an autoregressive distributed lag model, or ARDL.
ARDL. Sounds technical.
It is a bit, but basically it's a good tool for looking at relationships between variables over time, especially when those variables tend to trend upwards or downwards overall, like economic data often does. It helps make sure the findings are robust.
Okay, so it handles trends well. What variables did they actually plug into this model?
So the main thing they were trying to explain, the dependent variable, was FI, foreign investment inflow.
The amount of money coming in.
Exactly. Then they used PR, political restrictions intensity, using that 0 to 3 scale we talked about.
Right, the sanction pressure level.
They also included GDP, gross domestic product, as a measure of the overall market size and potential.
Makes sense. Bigger economy, more attractive.
Usually, yeah. Then OIL, which was oil rents as a percentage of GDP, to capture how important the energy sector is for Iran.
Can't ignore oil in Iran.
Definitely not. And finally, OPEN, which stood for openness, basically. Total trade as a percentage of GDP. This was used as a sort of proxy for institutional quality, like how easy it generally is to do business there.
Okay, so investment, sanctions, GDP, oil, and trade openness. What did the ARDL model find?
Okay, the key findings. First, the study confirmed there is a significant long-term relationship between all these factors and foreign investment in Iran.
So they're all connected over the long haul.
Yes, and specifically, the long-term effect of those political restrictions, PR, was found to be negative and highly significant.
Meaning more sanctions, less investment long term.
Clearly shown.
Very clearly shown. On the other hand, the long-term influence of oil rents, OIL, was positive and significant.
So despite the politics, the oil wealth still attracted investment over time.
It remained a significant draw, yes, even with all the pressure.
What about the short term? Did sanctions have an immediate impact?
Yes, they did. The study found the short-term impact of political restrictions, PR, was also negative and significant. So the negative effects weren't just a slow burn. They were felt quickly, too.
Almost immediately, yeah. Investors reacted fast.
How fast? Did this study quantify that reaction speed?
Sort of, yeah. They looked at something called the speed of adjustment, technically the error correction term, or ECT. The coefficient they found was negative 1.39.
Which means?
It means that if foreign investment gets out of line with its long-term expected level, given the political stability and other factors, it snaps back towards that level relatively quickly when stability changes.
So investment levels are quite sensitive and responsive to shifts in the political situation. They don't just drift slowly.
Exactly. It suggests a very dynamic relationship. Investors are watching closely and reacting pretty fast, sometimes even overshooting before settling back.
Interesting. Was there anything surprising in the results?
Well, one finding was a bit unexpected. The short-term estimated coefficients for GDP turned out to be negative and significant.
Wait, negative. So in the short term, a higher GDP was linked to less investment. That seems counterintuitive.
It does, yeah. The study offered a possible economic explanation. It might suggest that maybe the Iranian government actively tried to promote foreign investment in the following year, specifically when they faced budget deficits, possibly linked to a weaker GDP performance in the current year.
Ah, so it could be a government policy response, trying to attract FDI to fill budget gaps after a downturn.
That's one potential interpretation they offered, yeah. It's fascinating because it points to this active government role trying to counterbalance other economic pressures.
Okay, these findings seem pretty clear, especially on the sanctions. The study really seems to confirm empirically what you might suspect intuitively, right? That political instability is a major, measurable roadblock for foreign investment in Iran.
Absolutely. It's not just a background factor. The data shows it's a significant barrier with direct, quantifiable negative impacts on investment flows. Billions of dollars influenced by this.
So if we connect this to the bigger picture, what does it tell us?
Well, I think it really underscores how crucial multilateral negotiations and agreements, like the JCPOA is intended to be, are for actually fostering investment in a place like Iran.
Because they bring stability.
Exactly. That stability, that predictability, even if imperfect, is what investors need. When those agreements hold, it can create the conditions for investment. When they break down, well, the data shows a negative impact. It really raises the question, what's the economic cost of political unpredictability?
It's a huge cost, it seems. Now, it's always important, especially with economic studies, to talk about limitations. Did this study have any caveats we should keep in mind?
Oh, definitely. And the researchers acknowledged them. First, it is a single country study, so you can't necessarily just assume these exact results apply everywhere else facing sanctions. Context matters.
Right, Iran's situation is quite specific.
Very specific. Second, the time frame. It ends in 2017. That's before the U.S. pulled out of the JCPOA in 2018.
Ah, so a major event happened right after the study period.
Exactly. That withdrawal and the reimposition of sanctions likely changed the dynamics again, so applying these findings directly to the period after 2017 needs caution.
Good point. Anything else?
Yeah, the study didn't really dig into the characteristics of the investing countries themselves. Where was the investment coming from? Does a country's own relationship with, say, the U.S. influence how its companies react to U.S. sanctions on Iran? That could be another layer.
So different home countries might react differently to the same sanctions?
Potentially, yeah. It's a factor not explored here. And, beyond those specific points, empirical research always has challenges. Things like measuring institutional quality accurately using trade openness is just a proxy, and interpreting these complex ARDL models always involves some nuance. But the core finding about the negative impact of sanctions seems pretty robust despite these limitations.
Okay, so summing it up for you, our listener, the core message seems clear. Iran has this incredible economic potential, resources, market size, young population, even legal reforms trying to welcome investment.
All the ingredients seem to be there.
But its ability to actually attract and keep that foreign investment is fundamentally measurably tied to political stability.
Yeah.
And maybe even more directly to whether these external restrictions, these sanctions, are in place or not.
It's a stark reminder of how geopolitics directly shapes dollars and cents on the ground.
Absolutely.
And maybe a final thought to leave you with, building on that limitation about investing countries. Considering how complex this all is and the way geopolitics keeps shifting, think about this. How might the specific circumstances of an investing country influence its decision to invest in a sanctioned nation like Iran?
You mean like if a country's heavily dependent economically on the U.S., for example?
Right. Does that make its companies more likely to comply with U.S. sanctions, regardless of Iran's potential? Or perhaps less likely if they see a unique opportunity others are avoiding? How does the home country's own political and economic standing play into the risk calculation?
That's a really interesting angle. It adds another whole layer of complexity to the decision-making.
It does. It suggests the story isn't just about the target country and the sanctions themselves, but also about the players deciding whether or not to engage.
It really is an intricate dance, isn't it? Geopolitics, global economics, individual country interests, all tangled together. Something definitely worth thinking more about.
Indeed.
We'll keep pondering that. Thanks for joining us on this deep dive, and we'll catch you on the next one.